All right, there you go. The disclaimer shared one more time. What are we going to be talking about today?
Yes, I'm going to, one second. Sorry, Will, I think, hold on a second. I pressed on, unfortunately, hold on. Well, I gotta redo my screen.
No
I'm in,
worries.
I'm in my, test screen right now.
Fine.
That's what that I do this demo from, and I think I clicked on a feature I wasn't supposed to, so it looks like I'm frozen. Let me just try to bring up a different browser. All right, what's that, guys? So usually I just do these out of my internal. Okay, hold on. I think I got it. All right, let me share it. So I'm on SPY now. Sorry, guys. I do this. This is my internal website that I use to test new features. And if I press on something I'm not supposed to, it, I get error messages. So I took it down, brought it back up. Anyway, we're back onto SPY. And yesterday we were talking about our single leg dashboard, which analyzes the options that traded in this case SPY, that were single legs. So they were not part of a multi-leg trade. And yesterday we went over these top, I believe, 4 analytics. We stopped here, volume by condition. And since we don't have any questions, let's just continue to look at the different sections of this dashboard. And when we look at single leg trades, it could be a call or a put that's not part of like a multi-leg trade or a contingent trade. We could start trying to run analysis on it from different perspectives, so we could try to get some more insights. Okay, and so when you run analysis, a lot of times you run analysis and you're trying to answer questions. You could run it through a model, and this is what you think the most likely thing that happened. So there are questions we have where we don't actually have a definitive answer. Like, for example, well, here's a person from this place bought an option from this place. We don't know that for sure, but we could use the data, the evidence, the surrounding information to make an inference of what we think happened here. Okay, so one of the things that a lot of traders analyze, or analysts, research people, is what is the incoming order or the end user trying to do when they're using options. Okay, because you could be buying options, you could be selling options, and if you're buying options, then that means the demand to buy them. Maybe people think they're too low, too cheap, or there's just a demand to buy them for some reason, like an event coming up, or the order flow could be overwhelming selling them on the other side. So one of the things we look at is it fairly balanced? Does it look like it's more coming from the buy side or the sell side? And to do that, we could look at the trade prices versus the bids and the offers, which are a firm bid is where people are indicating they will buy it at this price. Actually, firm means they have to buy it at that price once they display it, and ask is they're willing to sell it at this price. So there are other things involved in it, but what we're doing here is looking first how did the trade itself compare to that market at the time of the trade? All right, so here it gives us a breakdown. All this thing, if we looked at the single leg trades and we compared it to the bid and the offer, just the bid and the offer at the time of the trade, we'll see 35% of all the trades equaled the bid price at that time. Okay, it happened on the bid. 36% of the trades were on the ask side of the market. So that just seems that it's pretty balanced, almost equal. But sometimes you'll get trades that, are not on the bid or the offer. It could be somewhere in between, right? So, and then when it's somewhere in between, right? Like let's say you have a dollar bid and $1.10. Well, if a trade happens at $1.08, yes, it's in between the dollar and the $1.10, but it's closer to the ask, right? If it happens at 102, it's closer to the bid. Or it could happen right in the middle, like 105. So let's break it down and say, all right, let's use first the midpoint. How many traded right at the midpoint of the bid and offer? That was 22%. Then we could say, well, if it didn't trade in the midpoint, how many traded closer to the bid? So this is below mid. This is where we say, okay, here's the midpoint, and it didn't trade on the bid, it didn't trade on the midpoint, but relative to the midpoint, where did it trade? Well, this one traded below the mid. So below midpoint means that it was closer to the bid, right? That's 2% of the volume. On the other hand, all right, if it didn't trade at the midpoint or the bid or the ask, it's somewhere in between. Where is it closer to the ask or the bid? So if it traded above the mid, that means it's closer to the ask. Okay. And that is 2% of the volume. So that's also pretty balanced, right? So far here, nothing looks that, there's a large imbalance of order flow to one side or the other. So we do also have situations where the trade price can trade outside the bid and offer, meaning it could trade below the firm bid or it could trade above the firm ask. And we discussed this yesterday because you can use a special order type called an intermarket sweep order. An intermarket sweep order is an order type that bypasses Reg NMS rules, which Reg NMS rule says that your broker is required to get you the best price available, which means he has to route it to exchanges that display the best price. But if your aim is to get liquidity and you don't want to necessarily go and route your order to, for each exchange because as it's doing that, the market could move and you could miss out on liquidity. You could send out multiple orders simultaneously to different exchanges and say, I'm willing to, get a price that may be worse than a different exchange, but I'm willing to do that because I want to grab the liquidity available before it goes away. Because what do you have? You have price, right? That's one of the things, but you also have the quantity of options available at that price. So that becomes important too, because if your aim is to buy, let's say, 100 contracts, well, if there's a price, on one exchange, like say it's offered at $1.10, but there's only one contract. Let's assume that that's it. That's all it's available. That, just because you want to buy 100 doesn't mean there's 100 contracts available. So now you have this one contract that somebody's trying to sell at $1.10, but everybody else is trying to sell, at $1.15. You see 20, you see another 20 at $1.15 on another exchange. You see maybe $1.15 on the third exchange. So in reality, right, what you're seeing in front of you is, yes, the best price is $1.10, but I need 100. There's 100 of them. 100 of these contracts are not available. And if I go try to get that at $1.10, clear that, and then go to the next exchange, and then go to the next exchange, as I'm going through one exchange at a time, the market could move and I'll miss out on that liquidity. So that's why people use an intermarket sweep order, because their aim is to grab that liquidity that they see before the market moves against them. And because you do that, you could see a price where you first go get a price that's inferior, right? Because you want to grab that liquidity. So when that happens, we're going to see a trade that looks like it was below the bid. Sometimes we'll see a trade that looks like it's above the ask, right? Because he grabbed the 115, he's like, there's 100 at 115, grab those and then get the 110 afterwards where there's one contract. So that's why we would see this trade through. It looks like a trade through. How often did that happen? You could see 1% of the time on each side. Those are more aggressive. Obviously, those are more aggressive order types, the intermarket sweeps. Now that we looked at that and we kind of get a sense of, there's a good amount trading at the midpoint, which means there's a good amount of liquidity in this stock, right? 22% of the orders are getting filled right at the midpoint, which means that as people are entering orders, there's good chance that you'd be able to negotiate for a better execution price than just stepping up to the ask or stepping down to the bid. And, add to that, how many traded in between, but below the midpoint, above it, another 2% on each side. So that's 4%. And that just kind of gives us a sense of the trade execution quality and liquidity in regards to trading in this security. So let's come down here. And now we have this next box with analytics. And this here looks at the biggest trades in SPY yesterday, single leg trades. All right, so this doesn't mean the option with the most volume. It's not the most active. It's just the biggest trade. So the difference there is here we have the options that are the most active. When we talk about most active, that's all the volume in that option aggregated throughout the day. You could have a trade at 9:30, 9:35, 9:40, 9:50, so on and so on throughout the day. And it grows and grows and grows. So that option is the most active. But you have a lot of you could have a lot of trades in there. With this option here, July 30th, the volume is 296,941. But that's an accumulation of a lot of trades throughout the day. Here, we look at just the largest trades that happened, either in one trade or it happened very quickly in a series of trades that look connected, right? So sometimes you'll have a trade that, like we were talking about, it could be an intermarket sweep where it grabs liquidity on multiple exchanges, but in a very quick succession. Let's say, in in milliseconds. So this is looking at the big trades of the day. And here we see one happened on July 30th expiration. So that's the 0 DTE in the 536 put. We saw 18,446 contracts trade for a VWAP price of 26 cents. And our interpretation of that trade, keep in mind, this is you have to run an analytic and make an interpretation, was that the incoming order was coming in from the buy side, bought, right? And so on. So these are like the biggest trades that we saw captured yesterday. Here's 13,600 and so forth. And this allows you just to kind of look at those top 5 and eyeball if there's anything in particular or unusual or trend, like what we think. So what yesterday, I'm just eyeballing it right now. And what pops out is all 5 were July 30th expiration. They were in the 0 DTs. Yesterday was, July 30th. So these expired yesterday. And all 5 of them were there. 0 DTs. It looks to me like it was a mixed calls and puts. Wasn't any one particular option type. We see put, call. The strikes ranged from 536 to 544. Let's see where the stock traded at. Stock traded yesterday between 538 and 547. So it had a very wide range, right? The stock had a pretty big, wide range yesterday. And we could see that also correlated to why the strikes are probably wide as well, because you got, the strikes between 544 and 536. I mean, that's $8, right? That's between the low and the high. But it probably just makes sense because of the volatility yesterday in the stock as it was moving around. And maybe, let me see, I'm trying to eyeball it, but just maybe the calls were more clustered towards the 543, 544 strikes, and puts were more downside. So that's just eyeballing it, but that gives us a little bit of information and a little bit of sense of what was going on in those top 5 trades. Okay. They all were coming in from the buy side. So it looks to me like it could either be trying to, buy protection against a position or short gamma, or getting long gamma on these trades. The next thing we could do is look at the volume breakdown just by the delta. Okay. And breaking down the volume by delta is doing the following. When you have an option, let's say a call option, well, a call option that's very deep in the money can have a 100 delta, which means that it's very sensitive to the stock move. If the stock moves up $1, the option is expected to move up $1 if it's very deep in the money. If the stock moves down $1, the option is expected to move down $1. You could also have options that are very far out of the money, and they're not very sensitive to $1 move in the stock. Think of an option that is a penny, right? It's a penny and it's so far out of the money that $1 move in the stock will not, a $1 move in the stock will not matter. That option is going to move very little or maybe not at all because it's just it's a wing or a tail, and it really needs a larger move before that option delta kicks in. And that's why when we look at total volume, right? When we look at total volumes, we got 7,500,000 contracts. We might want to see, well, what are the deltas of them? Because you could have 7,500,000 contracts in a penny option. That'll be different than in an option that is 100 delta. So this breaks it down by the delta in aggregate. Again, and then so we look at the delta in the calls and in the puts. So here we see that the wings in the calls represented 12% of the delta volume. And the wings are something that we say it's not at the money, it's not near the strike. It's more out of the money. So we consider between 25 delta and 5 delta isn't out of the money, but it still has some delta. It'll move with a dollar move in the stock, it'll move somewhat, but it's still a wing because it's out of the money. The stock still needs to, for that option to be in the money, the stock needs to, get there. It's a way. So 12% of the calls or the delta volume were in the call wings, 10% in the put wings. Okay. Most of it was around at the money. 26% of the calls were near at the money. 27% of the puts that traded yesterday were near at the money. Okay. Then we have the tails. The tails are options that are already far away out of the money that it's, you need a significant move then in the stock for it to reach there, at least for that particular stock, given the stock's volatility and the implied volatility, that these options, it would require a significant volatility move for that particular stock. So what are the tails here? We had 11% of the volume in a call, 13% in the put. Okay, with the tails, and then you have the deep in the money. This would be 95 delta or above, where these options move, very close with the stock price, dollar for dollar, and not that many, 1% on each. And this is probably, just looking at that distribution from on a daily basis, kind of looks normal to me, because usually in SPY, you'll see lots of trading around at the monies, or perhaps the wings, where you're going further out of the money, but not all the way out to the tails. So you could see here that's where the concentration was. In SPY, I think the tails also tend to be a bigger percentage of the volume than we see typically in other stocks, because there's a lot of closing out of options as well that are deep out of the money. So that's volume by delta. Well, we're right up at 9:30, so I think I'm going to stop.
Yep, the opening bell just happened, D. Great job as always. Thank you so much for bringing this to the Chameleon community. Everyone have a great day.
Yep. Thanks, everyone. Stay safe out there. Have a great day, and hope to see you guys tomorrow.
Great and peace, Chameleons. Everyone have a great day. Thanks, D.